Hey everyone, and welcome back to the channel. Today, we're diving deep into the world of financial titans, specifically BlackRock, ticker BLK, and its massive influence on how we invest. We'll also briefly compare it to State Street, another giant, to give you some perspective. BlackRock isn't just an asset manager anymore. It's practically a financial ecosystem, managing an astounding $14 trillion in assets. That's more than the GDP of most countries. So what makes BlackRock so dominant? What are its secrets to success? And is it a smart investment for your portfolio? Let's break it down in plain English. On-screen text, BlackRock, BLK, the $14 trillion giant. First up, how did BlackRock get so huge? Well, they built what their CEO, Larry Fink, calls a unified platform. Imagine a one-stop shop for everything finance. It started small, but two key areas really cemented its dominance. Visual aid, animated graphics showing a financial ecosystem, with iShares, Aladdin, and private markets as key pillars. 1. The iShares ecosystem and the passive revolution. BlackRock is the undisputed king of ETFs, or exchange-traded funds, through its iShares brand. By the end of 2025, iShares alone managed over $5 trillion across 1,600 different ETFs. Why are they so popular? It's all about the network effect. The more money that flows into these funds, the easier and cheaper they become to trade. This creates a self-reinforcing cycle of dominance in low-cost index investing, basically letting you invest in broad markets without paying huge fees. On-screen text, iShares, $5 trillion in ETFs and the network effect too. Aladdin, the digital brain of finance. But BlackRock isn't just an investment firm. It's a tech company. They have this incredible platform called Aladdin. It's like the digital nervous system for hundreds of financial institutions worldwide, including some of BlackRock's direct competitors. Aladdin provides cutting-edge risk analytics and portfolio management tools, helping these firms manage trillions of dollars. Think of it as selling the shovels during a gold rush, a resilient, high-margin business. In fact, their tech services revenue grew significantly in 2024. Visual aid, graphics showing, Aladdin, with data flowing between institutions. On-screen text, Aladdin, BlackRock's tech moat. Even competitors use it. 3. The strategic pivot, hello, private markets. As traditional index fund fees get squeezed, BlackRock is smartly moving into private markets, things like infrastructure, private equity, and private credit. These offer much higher fees and long-term potential. They've made massive acquisitions, like Global Infrastructure Management, GIP, in 2024, to position themselves for the estimated $85 trillion global infrastructure build-out needed for things like energy transition and digital assets over the next 15 years. This is a huge growth area for them. Visual aid, images of modern infrastructure, wind farms, smart cities, data centers. On-screen text, future growth, private markets and infrastructure. High fees, big opportunity. Now, let's quickly look at State Street Corporation, ticker STT, for comparison. While BlackRock is the asset manager and tech powerhouse, State Street is more like the plumbing of the financial markets. They specialize in investment servicing, acting as a custodian, holding and administering an incredible $53.8 trillion in assets for other institutions. They make their money from back-office efficiency and are also sensitive to interest rates, which affect their net interest income. On-screen text, State Street, STT, the financial plumber. $53.8 trillion in custody. Visual aid, simple bar chart comparing BLK and STT revenue and net income over 5 years, 2021 to 2025. Looking at their financials from 2020 to 2025, BlackRock shows aggressive revenue growth, especially in 2024 and 2025, largely due to market impacts and acquisitions like GIP. However, their net income in 2025 actually saw a dip, about 12.8% year-over-year. This is common when companies are making big, expensive acquisitions. They're investing for future growth, even if it impacts short-term profits. State Street, on the other hand, shows more stable, albeit slower, earnings progression, with their revenue jumping in 2023 to 2024, partly benefiting from higher interest rates. On-screen text, BlackRock, growth from acquisitions, short-term profit dip, on-screen text. State Street, stable earnings, benefits from higher rates. What about dividends? For income-focused investors, this is key. BlackRock has increased its dividend for 17 consecutive years, making it an aspiring dividend aristocrat. Its current yield is around 2.39%, with a payout ratio of about 60%, solid for income, but still allowing for reinvestment. State Street has an even longer history, consistently paying dividends for 56 years. Its yield is slightly higher, around 2.6%, with a more conservative payout ratio of 34%, meaning more room to grow or maintain payments even if earnings fluctuate. Visual aid, comparison table of dividend metrics for BLK and STT, yield, years of growth, payout ratio. On-screen text, dividends, BLK, growth versus STT, stability. Now, let's talk risks, because no investment is without them. For BlackRock, its very success has made it a target. Visual aid, news headlines related to ESG backlash or antitrust. 1. ESG backlash and antitrust scrutiny. BlackRock is at the center of the anti-ESG debate in the U.S., with some states suing them over perceived climate cartel activities. They're also facing a tricky balancing act, as some European pension funds are actually pulling money because they think BlackRock isn't being aggressive enough on climate. 2. Common ownership threat. A more academic, but potentially existential threat, is the idea that because BlackRock owns slices of nearly every competitor in concentrated industries, it might dull competition. If regulators act on this, it could fundamentally change the index fund business model. On-screen text, BlackRock's risks, political target, common ownership, debate. For State Street, the main risk is client fee pressure. BlackRock actually moved $2 trillion of its assets away from State Street to reduce its reliance and get better fees. This shows that even the biggest clients have bargaining power, which can erode State Street's profit margins. On-screen text, State Street's risk, client fee pressure and moat erosion. So, what's the takeaway for you? BlackRock is a classic growth stock within the financial sector. With a higher PE ratio, you're paying for its unrivaled scale, its technology moat with Aladdin, and its successful pivot to high-margin private markets. It's for investors looking for participation in the financialization of the global economy and the energy transition, but be prepared for potential volatility from regulatory and political headwinds. On-screen text, BlackRock, BLK growth stock tech scale, private markets. Higher risk, higher reward. State Street is more of a value play. With a lower PE ratio, you're getting a defensive business model, long-term dividend reliability, and potential upside if interest rates remain high. It's for investors seeking stability, consistent income, and a solid foundation in the financial plumbing. On-screen text, State Street, STT value stock defensive, dividends, steady. Lower risk, stable returns. Ultimately, your choice depends on your investment philosophy. Aggressive growth and innovation with BlackRock, or resilient value and stability with State Street. Both are giants, but they play very different, yet crucial, roles in the global financial system. BlackRock's unified platform strategy is currently winning the race for capital, but the regulatory finish line for both remains years, if not decades, away. Which one would you choose? Let me know in the comments below. Don't forget to like and subscribe for more deep dives into the world of finance. See you next time.